I'm recording now, right? Your name that you see there, that's going to show up. So if you're okay with that, if not, you can log out and log in again. Everybody okay with that? Okay, good. Good. Okay. Okay, so let's I'm talking about so we just added a group from Ottawa. So those of you who are not from the new group, it's okay that you're here. It's okay. We usually start our meeting at 9:30. I open the doors at 9:15, but obviously anybody's welcome, right? You can obviously jump in and review this stuff. Okay, so let's go for the tasks of the week. Okay, real simple. We're just gonna, try to establish different things for our business. So day one, create a separate email for real estate. Can be set up via Gmail for organization and separation from general email to allow for immediate response time to emails. Can be business name or personal name preferred for relationship building. So, did everybody get a chance to create their email? Does everybody have a separate email now? Good. If you haven't, that's okay. Just this week, get that set up, get that out of the way. We want to make sure that that's separated, so when we share information, that's covered. That particular email is the one we check for our business. Okay. Create separate telephone number. Can be set up via Skype. You can do it through Skype. Free phone line is just one site. You can go for organization and separation from general calls to allow for immediate response time to call. You can forward that number to your cell phone, I'm sure, and most of them allow you to do that and receive calls that way. Okay, thank you very much, Albert Nanny. Okay, good. All right, day three, create a business card. Can be set up Vistaprint's common one, set up with your new email and full name only. Keep it simple. This will allow you to write on the card depending on the contact with that person. Investor, builder, seller, you can just identify it based on the relationship. I wouldn't it's very important to control your communication, so I don't think it's important that you have your number on your card. You can add the number to the card and allow yourself to manage your communications with certain parties, and as you want to expand that communication, you just add the phone number or give them the phone number and whatever the information you'd like to share with them. Day four, create business space in home. This will be important to create an environment where the only use is business. This will also create legitimate space to write off expenses for taxes, stock with standard office supplies, keep all receipts. I think it's a good idea to keep all your receipts, period. Let your accountant sort out. You can consult with them and let them know and ask them what's the best approach for you to take concerning things like, what can be written off and what can't versus your home, okay? All right. Any other questions? Any questions? We good? There's a fifth one that I want to add. It's the mileage calculator. You can use Mileage IQ, something I use, but I mean, it's solely up to you. You can use any of them. It's just an app on the phone that tracks your mileage. So that's another good one to have to allow you to start managing. When you're moving around and you're looking at property, any sort of transportation that you're using. If you're trying to get from a meeting and you use an Uber, keep all those receipts. Okay. We good? All right. Any questions about those things? Are we good? If you're good, type in yes or why. Yes. All right. Okay, good. So what I'm going to do now is also I'm going to, let's see here, we're going to share those files. Let me see if I can find the last. Let's do this. Meeting. 1 second, I'm going to share those files with you, some files with you. Okay, so we're going to share the copy of cash flow sheet 4 if you don't already have it. I'm going to share cash for the week if you don't have it. Okay, you can copy those right now. You can just click on the screen and it'll download. Okay, if you're on a cell phone, typically doesn't work. I'm not sure why, but I'm sure there's a workaround for that. I've never tried it myself on a cell phone, but I know many of our students do. Okay. All right. Okay, so what I'm going to do now is I'm going to share my screen, and we're going to walk through the sheet together, the most updated sheet, which is the version 4. That's why it says V4. Okay. Any questions before I do that? Because now I'm going to pop my. You're going to see my screen. Are we good? Everybody good? Yes, good. Thank you. Thank you for the response. I appreciate it. Okay. All right. Excellent. Great is the word. Okay. So let's do this. Let's bring up the new sheet. Okay. So new share. Okay. I'm going to share my screen. Okay, that little black spot that you see, that's so I can actually see your questions as we go through it. So some of these things you're not going to completely understand. Don't worry, I'm going to go through them. I'm also going to give you a link to videos that you can watch that I record these meetings that you can watch over again that discuss these ideas and concepts. But I go over it a lot. I really think it's important for us to understand these metrics and why they are what they are. Okay, so let's start with the top here. I'm just going to move this down here for a second. The black spot there, you see. All right. So here we would just put the address of the particular place. Could be 123 Main Street. Here, standard cap rate. Now, cap rate, I'll explain after. Okay, cap rate's pretty important. Standard cap rate is something that you figure out or understand by identifying some properties, running some properties, and you'll see what the standard cap rate. And cap rate's basically a metric that tells you the return on investment versus the asset itself. So how much you paid completely. I can't see the screen, it's blank. Is anybody else having problems seeing the screen? Can everybody see the screen? You can see it? Well, I wonder why it's blank for you. Sure. Okay. You might want to log in, log out again, maybe to see if that works for you. I'm not sure why it's blank, or maybe open another browser. I'm not sure why that's doing that to you. Okay, so 123 Main Street. Okay, so standard cap rate, as it was saying, is like a return on investment on the whole amount. So let's put in $350,000 for the house, right? So let's say the list price is $350,000. What the standard cap rate does is it calculates the cap rate based on the amount of the property. So let's pretend there's a $350,000 property. It's 2 units. Let's say the money that it makes is $24,000 a year, and that's going to give us $1,000 per unit per month. Okay, open that up a bit. Okay, does that make sense for everybody? Okay, so don't worry about this stuff right here for now. Okay, don't worry about it. Okay, so 350. Where do you get the standard cap rate? Realtor. Yeah, you can get it from Realtor. Some realtors would be able to give that to you. Not all of them will. Residential property, it's not something they really look at because it's realtors deal with end users, and cap rate's more of an investor approach, or what a yield would be on a property based on that income. Okay, that'll make more sense when I explain cap rate again. I'll do that again tonight. Okay, so 2 units. So anything in yellow, you put the numbers in. This stuff calculates, what that is. So 2 units, $1,000 per unit. it's going to give us 24,000. So we take the gross number and the number of units. It tells us the $1,000 per unit. Now this should actually say, and if you're looking at your own sheet, you should put in here laundry. Okay, that's what that should have said, laundry. Okay, so laundry. So if you have any laundry income, say you make $400 a year on laundry, it'll add that to the income number. Okay, all right. So let's look at taxes. So taxes. Let's say the taxes on something like this would be around $3,500, depending where you are, but $3,500. Insurance will be, say, $1,500. Water and sewage, we're going to put, let's put $2,500. These could be anything, obviously. Let's just go $2,500. Heating, let's assume there's no heating. They pay for it. Others, we're going to take others out for a second and look at that, okay? So what happens is we put in these numbers. It tells us the monthly cost for that, okay? So the monthly cost. Yeah, Danny, asking price. That's right. The price that we're working with, right? $350. Okay, so we put in these numbers, and what this does for us is it calculates. This is trying to calculate our expenses, right? So we can figure out what our net operating income is, which is the money we get to keep it before financing. Okay, so as we put these numbers in, it tells us the percentage of revenue it's going to take up, right? We're going to see the monthly payment. You can't open the sheet. Okay, what happens when you try to open this sheet? Okay, if you don't enable, so disable the macros. You don't have to enable the macros, but you need to enable editing on the sheet that you get to be able to modify anything. You get a disclaimer, okay? So is it disclaimer about macros? Oh, it's from the down. You're still on the download screen, I think. Yeah. Did you download it? That might be disclaimer on the download. I'll let you work on that, okay? And if it continues to be an issue, let me know, okay? Okay. Okay, excellent. All right. So we come down here and we see vacancy, maintenance, and management, 5, 5, and 10, which are pretty standard. So the vacancy is 5%, the maintenance is 5%, and the management's 10%. Now, these could be higher or lower based on the age of the property. But for management, it's really not going to matter, right? The management's going to be around 10%. Maintenance is the one that could be higher or lower. So this could be 10, it could be 15 if it's really old. But really, I don't want you to go less than 5. And even if we don't use the money, we would keep it aside and use it in future use, okay? Same with vacancy. You could be out east where the vacancy is a bit higher. This could be 15. Whatever it is, put in the number. Should not go less than 5% though, okay? All right, just want to show you something real quick. So when I put 2,500 on maintenance, you can see that this number changes here. And the reason is because it's gearing up for 5%, but we're using actually more than 5%. We're using 10.2%, and it's changing the number. And this is actually telling us that we possibly could save money. But don't worry about that right now. You can play around with that as you go, okay? But these numbers will always be calculated in your metrics, okay? In your numbers. Now when we go down here, we see 14,880. That's the subtotal of all these expenses when you add them up, okay? That's going to tell us the net operating expense is 14,880, and that's going to be 61% of the gross income. So the gross income is 24,000. 61% of it's being eaten up by expenses. Okay, is everybody with me so far? Any questions? It's okay if you have questions. We're good? Okay. So net operating income is what's left over. Okay? So based on the expense and what's left over, that's about 40% of the income is going to be net operating income. That's the money that we get to keep before financing, okay? So that, when you see that ratio, 60 to 40, usually it's not a good thing. We'd like to see closer to 50, maybe, even a little bit more on the income side. So let's imagine that this expense wasn't here. You see, this is almost a 50%, right? That's kind of a good range. So in other words, of the income that we bring in, half of it's going to expenses. There's potential here, right? There's potential there. Well, we'll continue. So here we see financing. So first mortgage, it says 65 and 35. Really on a residential property, it's going to be 8 and 20, 20% here. If we decide, to put some money down, it's going to work it out right here. We put 20% down. There's going to be no financing, obviously, with that. But if we put here 20%, we're going to see that it's going to count financing based on the rate, right? So the first mortgage might be 3, the second mortgage might be 5 because it came from creative financing, okay? So when we come over here, is everybody good so far? Just the one quick thing I'll say about financing. When it's 2 units, it's going to be residential financing, which is going to be 80-20. But when this gets up to 5, this is going to be red because typically 5 and up are considered commercial. I would be more of a 65 for first mortgage, 25 for the second mortgage, and 10, for the down payment, right? And that down payment could come from anywhere. But this 65, it's usually 65 is what we're going to get from the first mortgage from the institution, okay? Typically it's going to be a little bit higher, so this could be as high as 5. Creative finance, it could be 7. And our own money is our own money, right? And again, we don't have to use our own money. We could be using other money. When we do, though, we should account for the interest rate and the term and the cost it would have on there, okay? So we want to make sure that we did that, okay? All right. Okay, so when we come down here, we start to get key indicators on the property, right? So what it's telling us, first one I'm going to point out to is here. So net operating income is $12,002. Debt service is $21,000. So what it's saying to us is, hey, you make $12,000, net operating income of $12,000. Of that $12,000, when you finance this property, the debt service is $21,000, which means your income that you're getting from this property after you pay expenses only covers just over half of what it's going to cost to finance, right? The $21,000, right? Which is right there. This is the cost of the financing. So what is that telling us? Well, it tells us for sure we're going to be losing money on this property. Does everybody see that? Now before we had here 80, and let's go 0, and just go 20. And let's go 3 here, and we see that this is 85. That's still too high. We'd like to see a coverage ratio of about 1.2. And so the institutions like to see 1.2. And the reason is, and I'll give you an example here. Let's go. Let's take this out for a second. That's going to get us to 1.3. I'm just taking out expenses to illustrate this. 1.3. Let's take this out. 1.38. So 1.38 is good. Means that we have your net operating income of $19,000, debt service is $14,000. So we have more money than we need to cover the expenses of the debt, right? That's the expenses of the debt. Does everybody see that? Does that make sense to everybody? Now, obviously, I'm changing the numbers. Whatever the numbers are, the numbers are. You can't change them. But this is important because you don't want to get into a property where you're financing it, and all of a sudden, you find at the end of the thing that you're not making any money at the end of the purchase, and as the money comes in, you're losing money, okay? So let's look at here. Now, cash on cash return. Let's make this a little bit bigger. Okay, so cash on cash return, what does that mean? What does cash on cash return? Well, it means based on the amount of cash that you put, which is 20%, $70,000, you're going to make 7.7%. Okay, is that good? Is 7.7% good on your money? 7.7%, is that good on your money? Better than GIC. That's true. Just what everything is. So 7.7% is not good, right? We want a better return than that. In fact, you know, when we look at it, we're trying to get closer to a 30 is kind of the objective. It doesn't have to be 30, but 30 is kind of the objective, right? So what it's saying to us is, you know, we're not getting a high enough yield on the money that we're putting inside, right? So we need to do better than that. So let's maybe do this. And we see 7.49. That's still no good. That's still no good, but that's okay. Let's leave that alone for a second. Then we got average profit per unit. It's telling us $43 per unit. Is that okay? Well, no, we need 75 per unit. And what this does is it's calculating per unit after we paid all our bills. After we paid all our bills, we've paid for vacancy, management, maintenance, all of that. After our financing, we're making about $44 per unit. That's not enough. We need to make 75, okay? GRM is actually a calculation of gross rent multiplier. That's what it stands for, gross rent multiplier. And really, it's a quick calculation of the gross rents versus the costs. I'll talk about it a little bit later. Don't worry about it too much. Just know that we like to see that number 6 or less. The lower the number, the better. Okay. Just it's a quick way to calculate if a property's, you know, got a good chance of making money for you. I'll talk a little bit more, like I said, after we get through this sheet. Current cap rate is 6. Okay. So 5.6. So this needs to be at 10. Okay. It needs to be at 10, and I'll explain why. But 10 means that we can make money on this property. Okay, there's profitability on this property. If it can't get to 10, typically we're going to lose money on it. All right, it's not going to be in a good position. $43 per unit. It's dangerous. We need to get a higher return than that. Okay. Cost per unit, I don't want you to worry about because it can be deceiving. It's more for multi-unit, 20 units, 30 units. You don't have to worry about that right now. And coverage ratios right now sitting at 1.6. We need to see that more than 20. And we talked about coverage ratio. That's what the banks are looking at. So the bank is saying, look, how much money do you bring in after you pay all your bills? You know, after you pay all your bills, how much money are you making? And can you afford to finance this property? You know, so when they see you know, that the net operating income is less than debt service, that's a problem. That'll be less than 1, right? Because this represents, when it says 1.16, it means you have enough money plus 0.16 to cover the expenses. So they want to see this number definitely over 1, but 1.2 is a nice safe place to be in. Okay? Any questions so far? We good? I know this is a lot of information, but that's okay. Don't panic, don't worry. It's something you're going to learn really quick just by using the sheet, and we go over the sheet several times. Okay. No questions? We're good? All right, let's continue. So then we have estimated property value, and this is interesting, okay? Because this is going to tell you, based on the evaluation, based on all these numbers, you know, what is this property worth us? Now it says it's listed for $350, right? Which is what the market says it's worth, $350. And once we run all the numbers and the expenses on it, let's change this back to 2. Once we change the numbers, run all the numbers through the property, it says, you know what? This is only worth $195,000. That's really what it's worth to us. $195 retail value. So I'll come back to estimated retail. Hugo, are you saying if that's retail value, the $195? No. So the estimated property value is actually what we estimate the value. So it's sometimes, but more often than not, it's going to be lower than the retail value. So retail value, $350, really is a function of what the market's doing in that particular area. So let me just do something real quick. So this estimated retail value is based on the property and the income and what that market decides that particular property is worth in a particular market. I know I'm saying particular and in a market. The reason is because when you calculate cap rate's an income number. It's an income evaluation on an investment, in this case property. So the standard cap rate is something that can give you an estimated retail value. So I'll give you an example. In Toronto, that's the cap rate. It's around, in Vancouver, that's the cap rate. You know, it's around 3, right? So in the core, right? So when you look at a property, if a property's, you have a property that's sitting at 350, and the estimated retail that we calculate is 650. There's a discount there. Estimated discount is 300,000, right? We're paying 46% of retail with this price, which tells us that we have an opportunity here. That being said, it wouldn't necessarily be a property that we would cash flow with, but it could be a property we could flip or we could wholesale. Okay, and I talked about this, and I talk about it a lot. Let the numbers tell you what to do. Let the numbers tell you what to do. We'll come back to this a little bit later. Okay, I want to come back down here. This is and this is it. In metropolitan cities, great question, right? In metropolitan cities, you're between 3 and 5. So in Ottawa, it could be closer. It's probably around 4 in Ottawa. Could be even 5. But it's really about areas like suburbs and stuff. They'll have it, and even if you go to a neighborhood, they can have their own little cap rate, because neighborhoods can be beside each other and really have a different cap rate. One neighborhood could be 6, which is saying that it's not the best neighborhood, or I shouldn't say that, but a neighborhood in demand. Another neighborhood beside it could be 5. The one beside that could be, could be 4, right? So what you're trying to do is understand, what is the cap rate of that area. That being said, I don't want you to worry too much about this right now. This is more of a, commercial type approach when you're looking at these numbers. When you're looking at residential, typically your realtor is going to be able to give you comparables, and that'll give you the number, right? Just comparables and the number. Unfortunately, most single-family homes are not going to cash flow for us in their standard state. We'd like to do more than break even or lose a few $100s. We need to either change the structure to maybe a rent-to-own lease option, or flip out the property or wholesale. It's something that's more of a capital gains approach, okay? But we don't want to hold the property. That's not going to make us money. So when we come down here, we see the property value, estimated property value is $195, and this quickly gives you an idea of, is there an opportunity here, right? Because that's our maximum offer price is $195. Now, when it's $195 and this is $350, there's not much opportunity here. We need this to be more realistically $225. Then it's not too far away. $225. We come down here. Well, that's a $30,000 discount, but it's something that we could possibly work towards and make happen. Okay, so estimated retail again is going to be based on this estimated retail right here, based on that cap rate. So let's say the cap rate in this particular area, to make it up, let's go 7. It's even higher. 8, around 8 or even 9, natural cap rate. Okay, so natural cap rate 5, natural cap rate. So we're sitting about an 8.5. So where can we find properties with an 8.5 standard cap rate? In other words, non-negotiated retail kind of state 8.5. Anybody want to tell me or take a guess? Where could you find a candidate properties in this range? Winnipeg, yeah, there's some areas of Winnipeg that might give you, maybe not quite that high, but that high, it could come up to that high. Yeah, there's another part of Canada that really, you can find properties that cap rate in that standard cap rate area. Anybody want to guess? So Winnipeg's a good one, yeah. Down east, yeah, east. Yeah, it's going to be east. Actually, the northern provinces or territories, their average price of properties is close to the average or even above average in some areas. It's pretty amazing. But there could be, obviously there's areas or sub areas in a province or a neighborhood or neighborhoods that will give you a better cap rate. Now, can anybody tell me why it's 8.5? Why in these areas would it be a standard cap rate would be higher? Anybody want to tell me why? So why would the cap rate be jobs? Yeah, when you say jobs, what do you mean by that, Dave? Low income, yes. Less population, yes. All that relating to economy is not strong, absolutely. So all that does, when we see standard cap rates at retail level at 8.5, typically it means this. vacancy is high as 25%. You know, like, because of those indicators that you established, yes, properties, because revitalization is not as common because these areas don't produce, a lot of money. Your maintenance might be in the 10 range, right? Your management could be as high as 12, but you can still find 10 most places in Canada. But that's going to definitely affect your numbers when these expenses start popping in, right? These are just 10,900 just on vacancy, maintenance, and management. So we haven't even added any other expenses here. Point being is, you can find properties like that, but that doesn't necessarily mean, it's a deal, right? But again, right, we can work on vacancy, we can work on maintenance to make these properties better. Typically, we're looking for a problem, and these properties in the east, and these particular areas in a province, neighborhoods, or that are not as in demand, that's a problem. So we can expect to make some money in those areas, okay? But we still run the numbers and make sure we figure out what it is, okay? So we come down here and we see, in this case, it's 225. Now that I've added these numbers, so these numbers here, and made them higher for that particular cap rate, natural cap rate, we come down here and we see the property is only worth $134,000. And the reason it's only worth $134,000 from that 225 is these things right here, right? Vacancy is higher, maintenance is higher, and management's higher. Now, if we see vacancies at 25, obviously we know we can get that lower by proper management. Typically, it's tired landlords and people who don't necessarily know what they're doing that have those kind of issues, okay? So again, if we want to make money, you got to solve problems. In this case, vacancy would be a problem. Maintenance, 10%, it's quite high. It's not impossible for a functioning property. It could be the age of the property, but typically that's going to be between the 5 and 10 range. 5 is pretty good and standard, okay? So we come down here and we see that we can again adjust for our financing to mimic what we think we can do here. So we put in the same numbers. This could be 3 and 5. To give us, an idea of what it is, and we see that at 134, all of a sudden, the property is appealing, and we see the cash on cash is 53%. The average per unit is 297. The GRM is 5.5. Gross rent multiplier. Current cap rate's 10, where it needs to be. Cost per unit not so important in this because it's only a couple units, and the coverage ratio is outstanding, which is 2.14, which is basically saying we're making twice as much money after we pay our bills. We have twice as much as we need to pay the financing portion of this property. So yeah, it would be excellent. Then we come down here and we see, when we start looking at offers, first offer with first offer, this would be a cash offer with VTB. This is where we're asking the individual to give us financing. First offer 114 with VTB 127. Remember, the maximum offer price here is 134. Now this number you see here is telling you versus the list price. So the list price is 225. So these numbers are quite low, obviously. 51 and 57, probably not going to be, something that's going to be accepted. But again, we need to figure this out and know these numbers so we can establish whether we should be spending additional time on that. So once you get through these sheets, you can quickly evaluate if you're sitting on an opportunity or not. If not, pass it. Go on to the next one. If you are, that's where we justify the additional time to spend on it, right? Now, all this is being done, I just want to remind everybody, before we look at the property, right? We're not looking at a property here, okay? This is not before we look at a property. This is us just running the evaluation and the numbers on the property. And at some point down the road, yep, you can go look at the property. But I really am not a fan of looking at a property unless the numbers make sense, because there's not a lot of reason to spend the time to do it. And we really want to be guarded with our time. Okay. So we look here, VTB, so the VTB portion, this is the seller's going to finance for us, $13,420. That really comes from this, because we're asking that second mortgage to come from them. I decided to make this 20, 100% financed, 80 from the bank, 20 from the seller. If we look down here, it just changes the numbers here, 26,840. It's just going to assume at minimum we're going to get that 20% down. the second mortgage, whatever we put in here is going to come from the seller. So if we look at that, we see a 5-year term, 65. It doesn't have to be 65. I was trying to make a point that you could put any number you want in here, really. Put 99 years for the financing. It would actually be better for the seller the longer it is, if they're interested in that for income. But let's say 30 years, right? So 30 years, interest rates 4, monthly is 127, yearly. What we're paying yearly is 1531, and balloon payment is the amount we're going to pay at the end of the term, at the end of the 5 years, right? We're going to pay $24,000. That's what's left on the mortgage to the seller. Now, if you look here, you'll see VTB, interest and principal, and VTB, interest only. And you'll see that interest only, we actually offer a higher percentage. Now, why would we offer a higher percentage of interest on this property versus interest and principal, right? Why would we say, look, if you go interest only, we'll pay you more, interest. And the reason is if you look here, the monthly, when we pay them at 1% more, we actually, monthly cost goes down to 111. Now, what would that do for us? Well, that's going to increase our cash flow, right? Our cash flow is going to be better because our expenses and financing are going to be less, okay? Yearly, we pay a little bit less. And at the end, though, you see that we actually owe them the whole amount, $26,840. Why? Because we've only been paying interest on this property, on this loan, and none of the principal. Okay, and you can see when we pay principal, it's a little bit less, about $2,500 less. Okay, total wealth accumulation is identifying to the seller. Look, if you give us a VTB with interest only, the total amount we're going to pay to you, the total amount you're going to make from this property, even though we're buying it for $134,200, you're going to end up getting this. You're going to end up getting a little bit more. Wait a minute, what's going on here? Hold on one second. $134,200. Oh, I see. Because we've only paid this $127 and $114. It would be different if it was $134. So by them selling us the VTB, so with VTB $127, we actually end up paying them $134,200, which is over this price. Okay, $132 if it's interest and principal. So we're paying $132,500, which is less than this, but closer to the price that we came up with versus the $127. And we talked about this. You can buy a property for less and pay more. That's what we're doing here. Okay, but this is all based on this maximum offer price of $134 and what we actually get the property for. In this case, it's $127 versus the cash offer $114. Now, cash offer $114 just means a standard mortgage, right? It's a standard mortgage. That's the property. $114 is what they're going to get. They're going to get a full payout from ourselves or our investors plus the bank. They'll get all their money. This is stretching it over, and you can see that we're willing to pay more, 10% more in this case, if they're willing to give us a VTB. Okay, so I can change that to. This can be changed to 75. It automatically bumps it up 10% with VTB because we want the VTB. We want the incentive for them for VTB because the more money we get from other sources, the less money we have to put in ourselves. Okay? All right. Any questions? Who's confused? Anybody confused? Yeah? All right, no worries. That's okay. Yeah, that's okay. Yeah, there's a lot there. Yeah, and this is to protect you, right? This is to protect you. These numbers, and this is why I want you to run this week. 5 properties in here, so you can see, even if you don't understand it all, you can see, what parts you don't understand, and that's when that's why we meet every Tuesday to make sure that we keep going and nothing holds us back or slows us down from being successful. Okay, so VTB, do you put a down payment? Well, you could put a down payment in a VTB. So I'll give you an example. Okay, so we could go like this. So first mortgage is 80%, second mortgage is 10%, total down is 10%. So we put down 10%. The second mortgage, always assume the second mortgage is the VTB. So the VTB in this case is only 10%, and the first mortgage is going to come from the bank at 80%. So when you see that 10%, now it's going to calculate it on the 13.4, right? You look down here, you see the 13.4, right? Whereas if we put this to 20%, it just, obviously if you put 20%, and the bank's giving us 80, we have zero, total down in this particular property. It's going to take the number now with the VTB and assume it's a 26,840 VTB. That's where it's going to make all its calculations, right? 26.4. Okay. Now we could change. There's lots we could change here. You could change the interest rate from 5, and that's going to pop it up 1%, because it's always going to want to give an incentive for the interest only versus the interest and principal. And you could change the amortization to 25 years. That's going to increase your payment. Went to 40 years. That's going to bring it down. Okay, that's going to bring it down. Okay, for interest only, the amortization is how long? There's no amortization, right? Because it's really just the term, right? Because when you amortize a mortgage, it's actually the amortization calculates when you'll pay it off. In an interest only scenario, you're never paying it off until you pay what's outstanding, the balloon payment. That's why that balloon payment is 26.84, and the interest only loan is 26.84. Yeah. Okay. Might have missed the beginning, but do we use this for purchase, flip, or rent? You can use it for any of them, actually, Danny. It's just, I'd rather you put in all the numbers, and then based on the cap rate and information in here, it can actually tell us what kind of deal we should be doing. Whether it's a flip, whether it should be looked at as a wholesale, whether it should be looked at as a buy, rent, and hold. So it could be any of those things, really, Danny. The big thing is to make sure that you get all the numbers. How much of a difference can there be between estimated property value and list price in order to make an offer? Well, I mean, urgency, right? The urgency of the seller, right? So, if this property was, say, 150,000. We come down here, it's 134. You look down here. Now look how close we are to list price, 76 and 85. That's doable. When you start breaking below 25%, so lower than the 75 versus list, you might have a struggle, right? Now, if it's a distressed property that's nobody's living in, you can go 50 cents on the dollar on that, right? Because you have to put money in before you get money out. So. But on a property, standard property, 25% cut's pretty good. It's pretty good on a property. 5% is pretty standard. To drop a property 5%, it's not a big deal. But once you start getting into 10 and 15 and 20, 25, there has to be a problem there to justify that discount the seller is giving you. Okay. Remember, right? We're looking at, depending on the strategy, we're looking at properties that are a problem. Right now, a single-family home on its own can be a problem. Right? We need to probably change that. $150,000. There's properties, I'm telling you, $150,000 that are duplexes or more, but they're problem properties, right? They're problem properties. Now, typically on a problem property, 150,000, 2 units, we're not getting 24,000. We're probably getting more like 15,000, right? At the end of the year, 625 is the average income. Now, when you see average income, it's 600s, 500s. You're usually dealing with lower income areas, right? Is that good or bad? Well, we don't balk at anything. If there's an opportunity, there's an opportunity. In a lower income area, we might decide to flip that property out, okay? So really run the numbers, and over the coming weeks, as you go to the Tuesday calls, as you go to the classes and stuff, you'll understand that really it doesn't matter, right? It's the numbers will tell you. The first thing you got to do is evaluate an asset and then figure out what's the best way for you to approach this asset to make money from it, or if you can at all, right? But there's so many things you can do with the property. So let me give you an example. I'm going to walk away from the sheet. Does anybody need more information on the sheet? Are you good? For those of you, all of you really, you should be running around 5 properties a week, just running numbers. For those of you that are brand new, just run 5 fictional if you have to. Just play around with the sheet. But it'd be great if you could use real properties. It's not a big deal. If you're looking for the information like these expenses, you can just email the seller or the realtor and say, can you give me the income expense statement, including all expenses, income from the property. That usually covers everything. What you don't typically see, or often don't see, is vacancy, maintenance, and management. You might see maintenance, but you won't see vacancy and management typically, because most people are managing their own properties, and so they're not paying that 10%. And vacancy, they pretend there's no vacancy, or they just give you the potential income of a property. So it doesn't matter if the vacancy in an area is 0. There's always time between a new renter and an existing renter. If the existing renter moves out, you're still talking 30 days. So, you want to make a buffer to make sure that you don't run into a situation where you're negatively cash flowing or not prepared for that vacancy. Okay? Any questions before I move away from the sheet? We okay? If you're good, type in yes. Good? Okay, so let me explain a few things. Cap rate's pretty important, so I like to talk about that a lot. So let's go back to the screen. Okay, so let's look at cap rate. Okay, so in explaining the importance of cap rate and what it means to us. So let's just take a $100,000 property. So if the property is $100K. And the net operating income, so that's after you pay all your bills, the net operating income, how much money do you make after you pay all your bills, equals 10K. Okay, everybody see that? 10K. Then my cap rate equals 10. Okay, that's my cap rate. All it's saying basically is that your return on this investment is 10%. Okay, that's what it is. So let me give you an example, right? And it's basically saying how many years will it take you? So it'll take us 10 years to pay this off. 10 years to pay this off. That's what it's saying. Okay. Now, if the cap rate's lower, that's not good, right? We want a higher cap rate than a lower cap rate. So if a cap rate on that 100K, if 100K now only gets us a net operating income of 7K, then the cap becomes 7. And the reason is, it's very simple, is we divide net operating income gets divided by purchase price. Okay, that's what it is. Net operating income divided by purchase price is going to give you that cap rate. Okay? It's just return on investment on the whole value of the property. The assumption is you're paying it completely off. Now, why do we calculate that? Well, because, especially in properties, because when you look at property, right, and the reason that we need a high cap rate, 10 cap rate, is because there's expenses associated with the property, right? And the expense that's associated with this property when it comes to net operating income is financing, right? It's financing. So let's go with a new whiteboard. So let's look at, okay. So let's look at, okay, so let's look at the 100,000 again, okay? So 100K, okay, is the purchase price, net operating income. Okay, so everybody knows what net operating income is, right? Okay. Yeah, that's right. So net operating income is the expenses like taxes, maintenance, vacancy, insurance, all that money, okay? But not a mortgage, not a mortgage. Yeah, it's PITI, exactly. Well, PITI, in this case, Peter, would include mortgage. That's principal, interest, taxes, insurance. So it's just that right? Insurance and taxes and any other additional costs, right? So net operating income is always before financing, always before financing. So if it's 10K, 10K, then the cap rate is 10. We all understand that? Is anybody not clear on that? That's okay if you're not. I'll explain it again. Does everybody understand that? How we got a cap rate of 10? Right? We divided the net operating income by the value of the property. Okay, good. Now, why is that important? And please, I want to reiterate this. If anybody's confused at this point, I want you to tell me. If you're confused, there might be somebody else confused. I don't mind going over this again, but I don't want you to be is in a state where you don't feel like you can do this, right? Or you can get past this piece of the puzzle, okay? It's fine. We're going to repeat it several times, but if you're not clear about something, this is the time to say it, right? This is the coaching, okay? So is everybody good? Everybody's good. Nobody has any questions? Everybody understands cap rate? At least how we calculate, okay? Yes, that's right. Okay, so look, if the cap rate's 10, why is that important? Well, if you do a cap rate of 10, that means you're making a 10% return. Your financing, okay, that means your financing, the cost of financing can go up to 7%. It means you can pay as much as 7% total. And what does that mean? We're still going to make 3%. You see? Does everybody see that? We're still going to make 3%. So 7% includes creative financing. Standard financing plus creative financing. Okay? That's why we need the 10. Right? Because if we're going to do creative stuff, we're going to do financing and creative stuff, then we got to have room to be able to finance this property and still make money, right? And still make money, right? The screen froze. Can everybody see? Yeah? Okay. Is it still frozen? Possibly? No, it's good? Okay. All right. Okay. So let me give you another example. Now, if that cap rate, right? If that cap rate is so the value of the house, let's say the purchase price is 100K, and the net operating income equals 3K, then the cap rate is 3K. Sorry, it's 3. I should just say 3 because that's what cap rate is. It's not a percentage. So 3. What does that mean? Well, it means that if you finance at all, right? If you do any financing, you're basically wiped out, right? If the financing is going to cost you 3%, you're breaking even at best, right? What if the financing is 5? Then you're down 2. You're negative 2. You're losing money. So most properties, based on inflation and interest rates and stuff, they run at break even, So a cap rate of 3, you can't make money on this property. You can't make any money on the property because the cap rate's too low. It's too low, right? 3 basically, not every time, but in a lot of cases, that's about break even. Cap rate of 3. But we're not in it for break even. We're in it for profit. Okay? Does that make sense? Why it's important? So we need that cap rate, that return high enough to allow us to do any creative financing or any financing at all, really. So we need that cap rate at a reasonable level. So 10 allows us to go as high as 7. That's the total cost of financing. The cost of it taking out of our net operating income for us to make money. Okay, so let's look at. Okay, so let's look at cap rates. Okay, so in Canada, like I said, you're going to be in the 3-4 range. Okay, so I'll come back to that in a second. Let's look at cap rates for a second based on that 10. So if a 10 cap rate is what we have, what does that say? What can we do with a 10 cap? So a 10 cap can give us cash flow. This is a buy and hold property. We can buy and hold on this property. Everybody see that? It's a buy and hold opportunity. If the cap rate is, say, between 7 and say 9, we still might be buy and hold, but now we're in what range? What range are we in? We're more in a, when we get to 7, it might not cash flow in a safe way that we want. So this could be a buy, fix, sell. Okay? If the cap rate was, say, 5 to 7, we could wholesale. Do you see this? You see how important that cap rate is? So as the cap rate goes down, it doesn't mean there's not an opportunity if you don't have a 10 cap rate. It just means it's not going to cash flow the way we want it to cash flow, right? So we're probably going in a different range. That's why we want the numbers to tell us what strategy to use. Now, there's a caveat here, right? The caveat is single-family homes. A single-family home can have a cap of, say, anywhere, actually it could be anywhere to 5 to, actually it could be lower. It could even actually be 3 to, in the low range, 3 to 7, you know. What can we do with this? If the cap rate on a single family home is as low as 3, not in every case that's going to work, but as it goes up, you know, even as high as 7, it's not quite 10, right? What could we do with that house? Well, we can't buy and hold it. You're absolutely right. We can't buy and hold at 3. We don't even like buy and hold at 7. So this is a great, you know, this property at 3 won't make any money, right? But if we do a rent to own, all of a sudden, you know, we can profit. We can profit even though the cap rate is low. Now, why can we profit when the cap rate is low? Well, we can profit with the cap rate being low because what's happening in rent to own? Well, what changes the cap rate? So the cap rate on a rent to own could start, you know, at a cap rate on a rent to own. So this is a rent to own. It could start at, say, a 5, which is not good for buy and hold, but, you know, a single family home. But if we evaluate this as a rent to own, so rent to own, my apologies, I went a little far ahead. So rent to own is what we're going to do with it. But if a property, let's just go a regular property, okay, let's go back here, get rid of this. So we have a regular property, so single family home is at a 5 cap rate. That's not good for us. It's not good for buy and hold, right? But if we convert this single family home to a rent to own, okay, the reason that it's going to work for us is because the rent to own is going to get the cap rate to, say, 7 to 10. Why? Why is it going to get a 7 to 10? Because the cap rate can only go up, right? Cap rate's calculated on expenses versus income. The reason is because the rent to own, unlike the single family home, has no what? Has no vacancy, management, and maintenance. And we know that these 3 things equal how much? Roughly 20%. So instead of us paying 20%, right, to vacancy, maintenance, and management of our gross income, that 20% now can go back into profit. That gives us a cap rate of 7 to 10 versus the 5 cap rate. Okay? Does everybody see that and understand that? Because those things have to be paid, right? Who's paying for them, right? They still have to be paid. Vacancy, maintenance, and management. But in this case, vacancy is addressed and covered and secured by the tenant buyer. Maintenance is taken care of by the tenant buyer. And management is taken by the tenant buyer. So because those costs now are being taken out of our expenses, that can allow us to profit from single-family homes. Typically, without that, single-family homes are not going to make money unless you get into areas, and it really in U.S. you can find them where houses are selling for $65,000 and the rents are coming in $800 a month, right? Where the average home is $65,000, right? You buy a house for $65,000, you rent it out for $800. Yeah, you can make money on a single-family home, but you still got to deal with the tenant versus the tenant buyer, right? Still prefer the rent to own. But in that case, there's enough income coming in because the house price is so low, right? And usually that's associated with low economic prosperity in a particular area. Okay. What happens if they default? If they default, so what happens if somebody defaults on a rental? Well, they lose quite a bit. They lose rent credits if we give them rent credits, and they lose the non-refundable option consideration, which is considerable, right? So, in an example, if we look at a, if we look at a, $400,000 house. Let's go three. It doesn't really matter. $300,000 house. 300K. I'm looking for a non-refundable option consideration of 12K to 15K. They lose this money. They lose that money. Now, does it happen? Can it happen? Of course it can, right? But the 12 to 15K allows me to do what? Well, it allows me to cover the expenses. Cover the expenses. To be able to put another tenant in there. Yeah, that's right, Marina. That's right. It's not valid, right? We get to keep it, right? We get to keep it, right? So in this case, we want to put somebody in our property. We want to produce income, but a tenant buyer obviously is going to be a better situation. Because they take away those expenses from us, then therefore we can produce more income. And at the end of the day, when you're looking at these properties or opportunities, it really comes down to that. You either change the structure or you flip it out. But you can't. Keeping a property that's not making you money typically is not a good idea. Typically, it's not a good idea, right? You definitely don't want to duplicate it and have a lot of your properties losing money. That's dangerous because in some points they're going to be problems in income, right? So Marina, okay, so Elizabeth said that the law changed. We can keep it as a non-refundable option consideration. We can't keep it as a non-refundable. There are other ways to keep a part of it. It is changed also for Quebec. So Marina and Jose, if Elizabeth is telling you that, she teaches it, and that's a thing she does, then you should absolutely follow her. So she showed you a way to work around the new change. Is that right? Okay, we'll just wait to get a response. She mentioned there's a way to phrase it in the contract different way. Good, excellent. Okay, good. This way you talk to a lawyer who does this all the time. Thanks, Dave. You're absolutely right, my friend. Excellent advice, right? Talk to a professional. The other thing is, and let me say something, whether it's called a non-refundable option consider or something else, that's a security for us, right? And there's an occasion where you do this as a tax strategy, breaking even. Okay, cool. The thing is I want you to keep in mind is, every time there's a law change or modification, is that good for us or bad for us? Every time it's harder for real estate to be done, is that good or bad? Well, yeah, it's excellent. You see, you're right. It's good because it keeps the rookies out. It keeps the people that are doing it wrong, that are doing it, badly, or doing it in a way that's not good for people. We don't want them in the market. So the harder it gets, the more likely they're going to bail, right? Or keep out of it. For us, we find the appropriate workaround within the law, obviously, to continue to grow our business. So we like it when it gets harder for people to invest in real estate because they're not educated, and we are, and we'd like the non-educated people to stay out of the market because they usually mess it up and make mistakes and push prices up where they shouldn't be. Let's be honest, if you had to pay cash for a property, there'd be no $1 million properties, that's for sure. Definitely we want to make sure that we take advantage of those changes, and obviously I'm glad Dave brought it up. Talk to a lawyer, talk to your trainers, talk to your mentors. These are the ones that are actively doing that particular strategy. They're the ones who are going to be most valuable in that case. Okay, and even then you're still going to talk to a lawyer. Good. All right. So again, the The cap rate, right, is very important to us because it'll really give us an indication of what to do, what strategy to apply for it. That's something we want to keep in mind as we run the numbers. So we run the numbers too before we see properties and decide what strategy and what approach we're going to take to that property. Now, those of you just want to talk to the newer people. If you have properties that you're looking at or properties that you own existing, please fill out the sheet, send it to me, and I can review it. If you do come across an opportunity, I'm more than happy to review it with you. Okay. All right. Any questions? Okay. So let me go over another metric. Yeah, a lawyer and accountant, is that what you're talking about, Hugo? So here, let me give you, whoops. No? My contact? Is that what you're talking about? I think you all have my contact. Maybe? Maybe what? I think you all have my contact. You all have my contact, right? Yeah, you all have it. Yeah. You can reach out to me anytime. Yeah, for sure. I give it to everybody in the program. A contact. Hugo, for what? Do you remember? I usually mention my lawyer. It's my lawyers because I think they're very important. Contract. Ah, okay. Yeah, okay. So anybody that's looking at okay, got it. Okay. Anybody that's looking at a property who wants clauses or a contract, I can help you with that. That's not a problem. Just send me an email. I can send you the contract. That being said, Hugo, you're gonna still review with the lawyer, right? Everybody still gonna review with the lawyer. Yeah, no problem. Yeah, no problem. I'll give you an example right now. Like I can give you a list of clauses, standard clauses, if you want. We can move into that. We have about 20 minutes, so I'm gonna just a couple more things I want to cover, and then you know what, we'll do a quick look at clauses, okay? And if you're in a situation where you're looking at a particular property, you can email me and we can look at a more full-fledged contract. What I want to talk about here is gross rent multiplier. Gross rent multiplier, GRM. Okay, what is GRM? Well, GRM takes the gross rent for properties. The gross rent might be, we go to a sheet here. Let's do it again. So gross rent multiplier, gross rent multiplier. So what it is to get a gross rent multiplier, and if you remember, we're looking for 6 or less. Doesn't have to be 6 or less. Gross rent multiplier. Okay. But what it does is this. So let's say you come across a property, and the guy says, "Well, the property's $300,000." You know. Oh, okay. And what are the gross rents? So you have no expense information or anything. What are the gross rents? The guy says the gross rents are $24,000 a year. What gross rent multiplier does is it divides this by this. So if we take, let's do the math. So if we take 300,000 and we divide it by 24,000, it says, oops, anybody got it? 300,000 divided by 24,000 equals, so the GRM is, yep, you got it, 12.5. Now is that good? Is that good? Do we want our GM to be high or low? Low. Yeah, it's not good. It's not good. We want our GRM to be low. So because immediately, and this is a rule of thumb, you can all work on this, you can all look at this. If the GRM is 12.5, it's not profitable simply because that's gross rent. That's just gross rent. There's no expenses in there. So if somebody gives you numbers, and this is just for a quick calculation, obviously you still run numbers if you think there's an opportunity. But if you come across a property with a 12 cap rate, GRM at 12.5, there's probably nothing there, and this is the reason why. A $300,000 property, 300K, with $24,000 a year, immediately I can make a quick assumption. I'm gonna have to take that 12,000, half of it off, right, for expenses. So that leaves $12,000, right? So this is the net operating income I would estimate, right? I'd estimate, obviously I'd have to run the numbers, is about 12,000. Well, that's a problem. Why? What's the cap rate? If this is a $300,000 property and the income's 12,000, well, I gotta take 12K divided by 300K. And what does that give me for a cap rate? Cap equals anybody? 4. That's the cap rate. Is 4 okay? 4 is terrible. Why is 4 terrible? Well, we haven't even financed the property yet. You know, at 4, how are we supposed to make money? There's no money here, right? There's no money to be made, right? So this immediately, you can go through again. This is a quick calculation that can tell you if there's an opportunity there. But at 24,000, you know, on a 300,000, there's no money there. There's you know, rarely you're going to find an opportunity where you're going to be able to extract profit. Now, here's another rule of thumb, okay? So a rule of thumb. So if 2,400 on 300,000 is not okay, is there a number we can look at that might give us an opportunity? Sure. If you use the 1% rule. What's the 1% rule? So if a property's 300,000 K, I need per month 3K. 1% a month. Okay? What is 3K in a year? 36,000. Everybody see that? 36,000. Right? 1%. Yeah, for rent per month. Yeah. Now 36K, I would do the same thing, right? I would immediately, these are just quick calculations, I'd immediately take away half of this, which is 18K. 18K for expenses, and then that would leave me how much? 18,000. That would leave me 18,000, right? Now 18,000, even this, look, even at 1%, what is the cap rate on that? Even on that one, oops, I made a mistake, didn't I? No, that's right, 36,000, 18. No, I made a mistake. No, 18 is 36, yeah, 18,000, yeah. What's the cap rate? It's 6. The cap rate is 6. Even at 1%, the cap rate's at 6, right? But 6, at least I'm in the range where I can start to do something with it. Remember, we were 5 to 7, we could wholesale 7 to 9. You know, we're in the range of flipping, and 10 and higher, we're in the age of cash flow. So if you're not getting this kind of rent, you know, and this is, again, quick calculation, we can still run the numbers, but 18,000 is about 50% of the gross income. That's typically where you're at for your expenses, you know, typically. But 1%, do you see this? Now imagine, can you get 3,000 on a $300,000 house, single family home? Maybe in some places, right? But typically, you know, that's going to be tough. Now imagine $1 million house. What do you need on $1 million house? 1% a month. You need 10 grand. 10 grand is 120,000 a year, and still, you know, that's going to be a challenge because you're never going to get the 10 grand. You're not going to get 10 grand a month typically. You're not going to get 10 grand a month on $1 million for rent. You know, you're not going to do it. So, you know, this is the kind of stuff and challenges we face. This is why we're very aggressive on running our numbers and making sure that a property is worth having, because most properties in a retail state, overwhelming, I would say, are not profitable. They're not profitable. Okay, they're not profitable. Okay, any questions about that? Should everybody get GRM now? So it's just gross rent multiplier. We take the value, or the purchase price divided by the gross rents for the year, and that gives us the GRM. Okay, any questions? let's hide this again. So this one was cap rate. I did that one. Let me get rid of that for a second. Okay. Okay. Any questions about anything we've talked about so far? Because I'm going to go into the last phase now. Anybody? It's okay if you do. Please let me know. Now, and if you, for whatever reason, if you feel like you don't want to, whatever your question you want to share with the group, you can send it to me. But I really prefer that we do it with the group, just so everyone can learn from that experience. I think it's wonderful when we share our questions, our ideas, our information, right? Because it really helps out the group. So, are we good? We're good? Okay. All right. If there's no questions, if there is, type it in. You're always allowed to type in questions, of course. So let's look at for a second here. Let me look at. Let's see if I have here. Load. Okay, let me see this. You know what? I should. Let me review this. Overwhelm you with intent. So this is an example document. I'm going to show you. Okay. Of things that would be in a contract, right? The letter of intent. Let me explain that. I'll explain that when I get there. Give me a second. Let me share my screen again. Let me share this with you. Okay. So. Let's go. Share. Okay. So I'm going to show you, and oops, and I'm gonna let you know something. Okay. I don't want you to worry too much. This is the first time you've seen them about the conditions. I'll talk about them. Don't worry about it. It's most important, obviously. When we do a contract, we'll address it then. If you have questions, more than happy to talk about it. We only have about 10 minutes, so we can discuss it further on additional calls. Okay, so let's share my screen. Let's share. Let's open that up. Okay. Okay. Does everybody see this document here? Okay. Okay, so I'm going to go through it and I'm going to explain some things and there's variations of what I'm showing you in a contract or what you would put in a contract, but these are some important clauses. So please add, it says please add the below clauses to the offer purchase contract. So let's say we see a property. We ran the numbers. When I say see, I don't mean physically, I mean numbers. We run the numbers. It looks like there's an opportunity. So what we say is, look, this is the offer we're going to make on this property. If these are the conditions, not the conditions necessarily, but these are the offer. This is the BTB. You put all that stuff in. And this is just an email. It's called an intent to offer, right? You say, look, if you like the numbers I've sent you, right, and this is all in one email, if you like the numbers above, please add the below clauses to the offer to purchase contract. So the offer to purchase contract is the contract we both sign, the seller and the buyer, to move forward on a deal. So we say to them, send me the contract, but please make sure these additional clauses are in, or some variation of it, are in the contract, right? Because if it is and the numbers are good, I'm going to sign it, right? I'm going to sign it because, at this point, I want to get control of this property and run my due diligence, okay? So let me give you an example. So if we look at, give me 1 second. Just change the map, the format. So if where are you? I missed the old one, to tell you the truth. Let's see. The old style layout. Here we go. So orientation landscape. Okay. So if we look at that, I don't want to do that, so it's all in there. I don't like this file because it's cutting off stuff. Give me 1 second. Okay. Corporation financing. No, I don't like this one. Give me a second. I'll bring up another one. Hold on 1 second. Okay. So this. My apologies. Give me 1 second. I'll set us up. Make sure we get the right file. I'm still with you folks. I'm just changing the format so you guys can see it, that's all. Okay. Okay, let's try this for now. Okay, I'm going to bring you back in. Just give me 1 second. I just want to be able to see all the writing on there, okay? Alright, just because the visual on it is not optimum. And before I forget, here, let's do this. I'm going to send you the link for the last video. It's right there. Everybody grab it if you don't have it. That's the last YouTube video that we did, okay? And then you can watch that. Subscribe if you haven't to the video to this station, and you'll be able to see all the videos, and then you'll be updated every time a new video comes. Okay? So everybody got that? You good? Good. All right. Especially for the new group. New group, you need to grab that link. Yep. Good. Just got a subscriber. Good. That way you'll know. So immediately subscribe so you don't. So you can see a video, because I'll post this video in the next couple days and it'll give you an email. Okay, share my screen. Let's go. Okay, so add these below clauses. Can everybody see that? Everybody sees that, right? Okay, good. So add these below clauses. Okay. Purchaser has the right to assign his or her interest of the property prior to closing to any person, corporation, entity, purchaser, sole discretion. Does everybody understand that? See that? And basically the corporation, entity, sole discretion upon assignment of the assignee, the new assigned person has responsibility for this property. Okay? Everybody understands why we have that, right? That's the assignment clause. Is there another way for me to get assignment rights? Can anybody tell me? Is there another way I can get assignment rights if it's not actually in the written like this? No? Nobody? It's alright if you don't know. Okay, that's okay. And or assigned. If you put your name, Sam Musa and or assigned, or your name and or assigned in the actual contract at the top. Okay? So typically, you know, you don't need to do that. You could put your name or your corporation's name and then put this in the actual contract, the Appendix A. Okay, that's the additional clause. Here, financing. This offer is conditional. See this? The offer is conditional upon the buyer obtaining at his own expense satisfactory financing for him or her said property on before, and you enter the date. Now, do you see the language here? At his own expense, satisfactory to the buyer, right? So typically this is bank financing, right? The bank financing is what, there we go, is what typically is in a contract. We're saying no, the offer is conditional on the buyer obtaining at his own expense satisfactory financing to him or for him, and it would be him or her, for the said property on before, and we put the date, say 14 days, 30 days, failing which this offer shall become null and void, and the buyer's deposit shall be returned without interest or penalty, okay? And that's ensuring that we get our money back, okay? If we put down a deposit, which we always want refundable. We always want that the deposit refundable. Income and expense verification. This offer is conditional on the buyer satisfied with the statements of income and expenses which the seller agrees to provide within 5 business days. This could say anything though. The days of acceptance of the offer, the period last 2 calendar days of the year, including rent receipts, each apartment to verify the tenants are paying a monthly tax, insurance, hydro, gas. Basically, we're asking them for the expenses, and they have to provide it within 5 days, okay? But you see what it says here? It says buyer, see here? It says buyer being satisfied with it. So the buyer's satisfaction is here. Now, that's pretty broad statement, and it's a huge advantage for us. If we're not happy with the income and expense statement, we're out of the deal, okay? Rent verification, the offer is conditional upon the buyer being satisfied with all the information pertaining to the tenants, including copies of their leases, names, units. Basically, again, within 5 business days, the seller agrees to provide all this information, okay? The buyer's right to request of any tenant so we're saying we want to be able to reach out to the tenants if we need to verify this information. Okay, that's rent verification. Property viewing, right to show. We've talked about all this stuff, but let's do it again. The seller agrees to cooperate in providing access to the property for the purpose of viewing the property. The buyer reserves the right to show the property, right? 24 hours notice. So we give them 24 hours notice, and they let us do that. Yes, Justin, they would. Yeah, they would. Never underestimate the motivation of a seller. And if a seller's legit, right, if their stuff is real, what are they worried about, right? Now, you're probably going to have more challenges than not with a realtor versus the seller. Because the realtor might say, well, why do you need to have the right to show? Financing, it needs to be bank financing. Some of these things are deal breakers to us. More than anything, we have to have one ironclad, at a minimum, one ironclad exit that allows us to exit the deal if it's not good. And I want to reiterate it again. We're not trying to hold up the seller. We're trying to verify the information they've given us to see if there's an opportunity. If there's not, there's no deal. If there is, we're more than happy to move forward with the deal, right? That's what we're talking about here. We just want to make sure we protect ourselves. Nothing in here is putting harm against the seller, right? It's not saying that the seller has to sell us the property for less than we've agreed. We're just saying if you're asking us for this price, all these things have to be in order. Is these clauses advantageous to us? You absolutely, 100%, you're absolutely right, Justin, they are. Are they so advantageous that it's going to affect the buyer, the seller negatively? It could if they're not legit, for sure, because we can get out of the deal. Okay? Does that answer your question, Justin? And again, expect some of these clauses to be challenged. That's a great question. Expect some of these. I've put in over 20 clauses in a contract before. We expect them to knock some of these out. But if they knock them out, what do we always say? If somebody doesn't want a clause in a contract, what do we always say? Someone says, I can't do that, or we can't do that. What do you say? Yeah, you just say, why? Why? What's the problem? Tell us what the problem is, and let's see if we can figure out a way to get you what you want, and we'll get what we want, right? We're reasonable people. Absolutely, we're reasonable people. Insurance coverage, right? Property has to be insurable. How important is the insurance? Well, you cannot get financing typically without insurance, right? Someone's not going to finance a property if there's no insurance on it, or it can't be insured, because the lender is now exposed. If something happens to the house, they're not going to get paid. They're going to have to go after you for it. And when you're talking about even a few $100,000, the likelihood of getting that money in any real lump sum amount for the seller, for the lender, is not a good plan, right? So the lender wants to see that there's insurance on the property just in case something happens. Then we have approval This offer is conditional upon the approval of terms of the buyer's partner and solicitor. All it's saying is, look, our partner has to see it and our solicitor has to see it. That's all. That's all. That's all that says, okay? So there's a variation of these agreements. I just brought you the one I had here, but there's a variation of these agreements and additional agreement clauses that we can put in a contract. These ones are pretty key. So in an email, you would say, look, this is my offer, this is my cash offer, this is my BTV offer, and these are my conditions. If you like my offer, please add these conditions to an offer to purchase contract. And each province will have their own offer to purchase contract. You can literally use the standard offer to purchase contract that a realtor has, right? You can use the ones that in your particular province, right? So that offer to purchase contract is a legal document. What we want is we want to take that document and we want to amend it. We want to add additional information, clauses to it to protect us. That's all we're doing, okay? We're not going to, sign a contract that doesn't put some protections in for us, right? And it's not to hurt or damage or put the seller at a disadvantage if they're for real and the property's for real and the income numbers are for real. It's what we think it is, and if the opportunity does pan out to profitability for us, then we're more than happy to buy it. But we're not going to be stuck with the property because the contract stuck us with the property. Does that make sense? We don't want the contract to stick us because we find out later the property doesn't make money, as we're running our due diligence, and all of a sudden they say, well, nope, sorry, the contract says that you have to buy this. Now, we're not okay with that. So yes, these clauses are definitely going to be on our side, and the advantage is going to be for us for sure. Okay? Any questions? And what I'll do, I could give you a mock contract. Let's do it next week. I get nervous about that. I just don't want you to start pumping these things out without some review of your lawyer, your own lawyer, and or myself or someone, your mentor, somebody seeing it. I'd rather you spend an extra step to make sure you're protected. Okay, so does everybody understand that? It's very important that you protect yourself. It's very important that you do these things right. We can't afford to make mistakes, right? We can't afford to be sloppy. We can't afford to gamble on our future, right? So every property that we bring on board needs to be, somehow benefiting us, right? We want to make sure that's true, okay? Awesome. Okay, any questions? Any questions? Can you share these docs again? Yeah, the original docs is the same link. Yeah, the same link. So a couple things. Let me do this, okay? Okay, so first thing I'm going to say is everybody who doesn't already have done it, you should save this link as a favorite in your web browser so you can always come back to it, because yes, I use the same link every Tuesday, okay? And it's always 9:30 Eastern, 9:30 Eastern Tuesdays, okay? Unless something comes up, I will contact some key people that have Facebook, and they'll let everybody else know that it's been changed or modified, okay? But otherwise, it's going to be Tuesdays. Weekends and holidays, holidays, there might be an amended schedule that we just take a couple weeks off like we did for New Year's and Christmas, okay? So this is what I'll do. Here, let's go back to stop sharing. Okay, hold on. Okay, so I have the copy of the cash flow, the tasks of the week, and for contracts, you email me, okay? If you got something going on, let's say next week, let's do just contracts, okay? I will bring a full-fledged contract that will go over the important parts of it, okay? But I don't want anybody to, and I'll give you a download for it. But please be careful. I don't want anybody to go crazy with it, please. And make sure that you consult a lawyer. Can everyone promise me that, please? I just want you to make sure that you protect yourself. It's very important. So copy of cash flow sheets up there. Tasks of the week are up there. And next week, we will focus on specifically contracts and agreements, and I will present a offer to purchase contract. The thing I want you to keep in mind, though, is each one of you, there's many of you from different provinces, right? You're different areas of Canada. You want to use the offer to purchase contract of that province the additional clauses you'll add to it. And I'll show you that. I'll show you where there's an Appendix A where you add these additional clauses. Then on top of that, when it's time to do this, I just want you, okay, to talk to your lawyer. Make sure your lawyer sees it, understands it, says, yeah, you're good, you're covered. And then you can pump it out as many times as you want, right? But you need to vet it somehow with your lawyer, because I want you to take care of the, make sure that you're using the laws and regulations of that particular province. Okay, does that make sense to everybody? Yeah, we good? Good. Okay, we are done. We are done for today. Everybody, there's about 25 of us on right now. I want everybody to say hello to the people from Ottawa that have joined us, new group. If you're from the Ottawa or even Quebec area, I want you to, maybe we can talk a little bit about that, because contracts won't take the whole thing next week. We can talk about letting people know where you're from to allow them to get your information and maybe, take advantage of that network group, okay? Okay, Albert, yes, so, Albert and Annie, yeah, we can do that. We can do that. Okay, so, yeah, Albert and Annie, let's do, okay, well, you know what, we can, well, let me do this. Okay, so we good, Albert and Annie, stay on. Everybody else, are we good? Any questions? We're good. If you're good, type in yes. Or Y. Y is good. Yep. Awesome. You're a great group. All right. So, my pleasure. So, I'll see you next Tuesday. The video will be posted in the next couple days. Make sure you subscribe. Everybody got the link, I hope. And review the video again. If you have any questions, you can bring in, or any of the videos. And I will see you all next Tuesday. So I'm going to stop recording. It was a wonderful day, and good hunting this week, okay? My pleasure.